Okay, so let's start tonight with questions on the homework. Do you guys have a specific one that you want to start with? Anybody? Chapter 2 homework, go ahead, or Chapter 1 even.
I have a question on 2.5. So, it was...
Help me out real quick. What page are we on? Just so I can get there.
I have 7 editions.
That's fine, so do I. M2.5. Okay. For each of the following transactions...
Wait, I'm sorry, 2.6.
2.6.
Yeah.
Identifying increase and decrease effects on balance sheet elements. Complete the following table by entering either the word increase or decrease in each column. Cool. All right. Let's start this way. What's our basic accounting equation? Assets equals liabilities plus stockholders' equity. Okay? Now, treat them each as a T account. So if we have an asset like cash, it increases, well, before I even go there, let's hit the technicals. Which side is that side? That's the debit side, abbreviated DR. Which side is that side?
Credit.
Credit side, abbreviated CR. Now, on liabilities, is it the same or does it change? It's always the same. Do you need to zoom in? Good. Okay. So, assets increase on which side? Debit side. They decrease on credit side. Good. Am I going where you wanted to go?
Actually, it was 2.5.
Well, we're going to finish this one. That's okay. We'll go back to 2.5, but we'll finish this one. Okay. Liabilities increase on which side? Credit side. And they decrease on debit side. Stockholders' equity increases where? Credit side, and decreases debit side. So, just as a way to think about it, assets increase on the debit side. When you cross the equal sign, everything increases on the other side. Good? Okay. So, let me finish the rest of the equation. Assets equals liabilities plus stockholders' equity plus what? Minus. So revenue increases on which side? What?
Increase on the credit.
Credit side, okay. I didn't hear you, that's all. No, I didn't hear you. I apologize. Revenue increases on the credit side. Hello. Nice. Technology, we love it. Expenses increase on which side? The debit side. So notice, I'm still on this side of the equal sign, but all of a sudden I increase as a debit again. Why? The minus sign. You guys got it. Okay, everybody's good with this? Okay, I can't see. So, we'll turn that off. The whole machine rebooted. Good. Right when I need it. Okay, so let's go back to 2.5 and answer questions for 2.5 then, okay? For each of the following transactions for the month of January, indicate the accounts, amounts, and direction of the effects on the accounting equation. How about we take it one step further and we'll just put up T accounts and post the entries into T accounts? Right? Because that effectively does the same thing, yes? Okay. So A, borrow $20,000 from the bank. Well, I'm going to clean this up a little bit, and we'll try and use our T accounts. Okay, so if we borrow money from the bank, what do we get? We get an asset, but what is the asset specifically? Cash. So cash goes which way? Up. Up. Cash is an asset. It increases on which side? Debit. So I would post a $20,000 debit here. Okay? What are we giving up? We got $20,000 for what? A loan. So we have a note payable, which is a liability, right? Liabilities increase on which side? The credit side. So I'm going to post the $20,000 here. So the answer to this is my assets increased by $20,000 and my liabilities increased by $20,000. If you were to do it to the specific accounts, it'd be cash, debit, note payable, credit. Good? Questions? Okay, what's the next one? Somebody want to read that for me?
Lend $7,000 to an affiliate, accepted a note due in 1 year.
Okay, so we're going to lend money to somebody else. So what are we getting? A note receivable. Let's plug that in here. Note receivable. And is that an asset or a liability? It's an asset. How much was it?
$7,000.
Assets increase on which side? Debit. And what did we give up?
$7,000.
Cash. Cash goes up or down? Down, because cash is going out. Cash decreases on which side? $7,000. Good? Now, if we were doing this properly, we would be marking our transactions so that we could follow our way through it, creating an audit trail. This one would be B, like so. Okay? So you can see these two go together. That one goes with that one, and so on. Questions? All right. Can somebody read C for me, please? So we sold some stock to investors, correct? Okay. What did we get? Cash. So cash is going to go which way for us? Up. Debit. So I got a $1,000 entry to cash. And what am I giving up? Stockholders' equity, right? And it increases on which side? Credit. So I've got a $1,000 credit here, and that's C. Now notice, debit, credit, debit, credit, debit, credit. So I stay in balance, right? For every debit, there must be a credit. For every credit, there must be a debit.
This is what I had a question about the stock. The stock in general.
Mm-hmm.
It's not money, but it's something that goes towards the business or people buy it.
We got money. They paid us money for it, so it has value.
Right.
Okay? But what we gave up was ownership rights in the company.
Okay. So that went up. So
Right.
shouldn't it go down?
No, it's a liability. Right? Well, think about it as if it were a sole proprietor. Right? Cash went up, and in exchange you got stock or owner's equity. Same thing, same concept. Owner's equity increases as a credit. So to the owner, this is an asset. To us, the company, this is a liability in that we owe them part of the profits of the company. Right? And they're expecting a return on their investment, much like as if it was a loan. So does that help you think about it? Okay.
But it's not in the liabilities
No, it comes after liabilities. It's its own, it's in the equity section. So think about it. There's two ways to finance a business. I can borrow money from others, or we can use our own money. This is our money, and liabilities are we're using somebody else's money. Okay? In the real world, whose money do you want to play with? Other people's money. Right? But you got to put your own skin in the game or they won't lend you the money. So that's what goes on. Good? Yes?
I was wondering, I don't know if it's different in the 7th edition, but in the 8th edition, I was wondering if you could go over it in the book, because it talks about common stock and additional paid-in capital. So like you debit cash and you credit common stock and additional paid-in capital, because it says sold 100 additional shares of stock
Okay.
with a par value of 10 cents per share for 500.
And that's in chapter 2 or 5?
2.
It's in chapter 2.
8th edition, anyway.
All right. Let's talk about that, because somebody else asked me before class. So the book mentions stock, which is what we sold here for $1,000. Okay? Stock, has anyone ever seen a stock certificate? No? Maybe? It's, a piece of paper. It's usually is fairly ornate, has a company logo or some picture on it. People collect old shares of stocks because the pictures are really ornate. Like some people will collect all railroad stocks from, the 17 and 1800 kind of stuff. It's, yeah. But on it, it's basically a contract, and it goes through blah, blah, blah. You have the right to X number of shares of this company, blah, 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 as evidenced by this piece of paper. And on it, it will say that the stock has a par value. And it will have a number. It'll be $1, it'll be $10. A lot of times you see it a penny. Par value, all it means is stated value. The piece of paper says that it's worth $1 a share. Let's just use $1 as our example, okay? So the stated value, or par value, is $1. I'm going to come over here. Par value is $1. Okay? Does this have anything to do with what the stock will sell for? Even on day number 1, when they go out for an IPO, the stock could sell for whatever market is. Market may be $29. It has nothing to do with this. Okay? So, in total, somebody paid, let me change this. Let me make the math easy. $30 is what the market is. Okay? So they sold the stock. The company sold the stock in an IPO for $30, but they have a par value or stated value of $1. Everybody cool with the concept so far? Okay. So I'm going to do it as a journal entry. The company sold number of shares, let's say 1,000 shares. So, how much cash did the company get? 1,000 times 30, correct? So the company has a debit to cash for 30. Oops. Put the comma in the right place and we'll all be happier. Cash increases by $30,000. This will be my debit column. Credits are going to go over here. So we got cash. We gave up what? Common stock. Common stock is always recorded at par value. Always, 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 and it never changes. So 1,000 times 1, my common stock is 1,000. Okay? Am I in balance? Do my debits equal? No, my debits do not equal my credits. So you have this other thing called additional paid-in capital, and that would be the other $29,000, so that you're in balance. Additional paid-in capital. The book sometimes refers to it as capital in excess of par or something like that. APIC, additional paid-in capital, is how I learned it. Capital in excess of par works too. They mean the same thing. So if you look at your companies when you're doing the analysis, and it'll be in homework problems as well, it'll say that The stock has a par value of $10, and the capital stock account has a $100,000 balance. How many shares are outstanding? Do the math. 100,000 divided by 10, right? So you sold 10,000 shares. Good? So you can figure out how many shares there are floating around that way. Par value is stated. It's on the stock certificate. So the company will pick a par value. There's some legal rules about their liability and risk. So sometimes you see like a penny for par value. I'm not going to worry about that for tonight. All right? So does that explain what additional paid-in capital is and par value? We'll get into it more as we go through this, I promise. Good? Was that a smile or was that a look of pain that I didn't get your answer? Yes. Okay, so it was a look of pain, but about something else. Okay. Oh, I hate that idea. Okay. All right, are we good? Okay, which problem are we on? 2.5. Have we done any of it yet? Which one are we up to? D. Purchased $15,000 of equipment, paid $6,000 cash, and the rest on a note payable. Okay? So we need a new account for an asset called equipment, which I will abbreviate. So how much equipment did we buy? $15,000. It's an asset which increases on which side? Which side? Debit. No. What? I didn't hear that. Debit side. We left those two words in the dust long ago.
I had letter D next to it because it's problem D, so.
Oh, okay.
Sorry.
So that's D. We got $15,000 worth of equipment. What did we give up? We gave up some cash. How much cash? $6,000. $6,000 credit, $15,000 debit. I'm not in balance yet, am I? How did we pay for the rest of it? A note payable due in 1 year, right? So the difference is, no, try 9. I don't trust my math after 6 o'clock, but so I've got, excuse me, so I've got a debit, a credit, and a credit. There's $15,000 debit and $15,000 credit. Everybody good at that? So it is in balance. If you were to write that as a general journal entry, we've talked about the general journal, yes? Okay. It would look, I'm going to erase this. We would have a debit to equipment for $15,000, credit to cash for $6,000, and a credit to note payable for the other 9. Okay? Everybody happy? I'm happy. You happy?
Yes.
All right, good. What is the next one? E.
Of course. Declared and paid $2,000 in dividends to stockholders.
Declared a $2,000 dividend.
So declared cash-free.
And paid.
Oh, and paid.
And paid. Okay, so we're giving up what? Cash, right? Cash goes up or down? Down. Cash decreases on the credit side. $2,000. E. Good? Where's our debit? It's in stockholders' equity, but it's going to be in a subcomponent of that. Retained earnings. So we have a credit here and a $2,000 debit to retained earnings here. There's two parts to stockholders' equity. It is the capital stock, which is the money everyone paid for the stock, and retained earnings. Retained earnings, the definition is it's the accumulated earnings and profits of the company from the beginning of time, forever. So every time they have net income, it increases retained earnings. If they have net loss, it decreases retained earnings. If we declare a dividend, distribute some of the profits out of the company, it reduces retained earnings. Good? It's the same thing as owner's draw from a, not really. When you pay a dividend, it's the same thing as owner's draw, but when you're adding net income to it all the time, it's truly the same thing as owner's equity. Okay? So it's a little different in how it behaves. Question? Yes?
If the problem didn't say paid and it just said declared, how would you handle it?
Instead of being in cash, it would have to be a credit somewhere, so that's a liability. So it would be a payable.
Dividends payable or something? Or would
Yeah.
it like be
Dividend payable, $2,000. Okay? And then when you paid it, you debit this and credit cash. Yes? Was there another question? Yes?
I'm kind of confused on the retained earnings because in the description that it has in the book, it says refers to the cumulative earnings of the company that are not distributed to the owners and are reinvested in the business.
Yep.
And so,
Retained earnings is the cumulative earnings and profits of the company,
right.
net of any dividends distributed back to the owners. So,
Yeah, I guess I was confused because since the stockholders are part owners.
mhm.
and-
They're not part owners, they are owners. So let's look at it a different way. Let me do a little example for you, Eric. If I put retained earnings over here, let's say it's a new company, okay? So the first year we make a profit of, say, $100,000. Stockholders' equity increases on the credit side. So this is net income. Let's say the second year we had a loss of $10,000. Well, let me make it 20 so the numbers look different. This is a net loss. Okay? Our balance right now is $80,000 positive. Let's say in year 3 we have a recovery and we have a $120,000 net income. My balance at this point is $200,000 in retained earnings. With me so far? Yeah? And then we go out and we get crazy and we say, look, we've had a profit for a couple of years, we got some money built up, let's do a dividend, let's give some money back to the owners, let's hand out $80,000. It serves to reduce the balance. So our new balance would be $120,000 in retained earnings. So it's the cumulative earnings and profits of the company, net of any dividends paid out. I'm really saying the same thing that the book does, just probably not as eloquently. Other questions? Yes, sir.
So when you pay out dividends, that's not affecting stockholders' equity. That's just like
Stockholders' equity has two components. Okay? It's the stock that's been sold and retained earnings. So it does affect the total of stockholders' equity.
all right, but it doesn't affect the amount of stock sold.
It doesn't affect the stock account at all.
Okay.
Okay? Yes, sir.
For the loss, can you credit a negative value, or do you debit it if it's negative?
No.
Can you just write it in brackets and put it on the credit side?
Excellent question. So remember, when we went to debits and credits, right and left went away, and positive and negative went away. So I don't want to put something down as a negative number. It by definition is the other side of the T account, so it's a debit. Okay? You'll appreciate that more as time goes on. Clear enough, or? All right, good. Other questions? Yes, sir.
Just on the A, B, C, D, and E thing, is that how it's normally done in like the real world, or are there like, would there be like different titles for each of those if it was like a real company?
This is a reference showing that they're part of the same transaction. In the real world, there's a posting reference, and I'm making one up here just because all we have is A, B, C, and D.
Yeah, but
Okay.
will they like the reference just like be like A, B, C, D and the reference, and then it would be listed A, B, C, D, and E there, or would they have like a name for like some type of transaction or something?
These first, everything gets entered first into the general journal. So this is your general journal. So, and those are just in chronological order. So this would be 1-1, we did this. 1-5, we did this. Okay, and then there'd be the next one and the next one. Then these get posted. Remember we talked about the general ledger, which is your list of all your accounts. So they'd all have a number. Cash would be 100, equipment would be 150, note receivable would be, let's call it 130, note payable would be 200. So they'd all have a number. So when you post from the general journal to the general ledger, you would come up with a posting reference. So equipment is 150. So when this gets posted to here, you would put in the page number for the general journal as your reference. And when you write in the account number here, that tells you that this has been posted. In a big company, you know, there'll be multiple people that do this. So one person does this, one person does this, somebody else will do this. So that transaction is partially posted. If you looked at this one and it had a number here, here, and here, that transaction is completely posted. So if you picked this up and it was your job to do cash, you would know, oh gosh, I need to do this. Okay? But those become your reference, your posting references. Too much detail, right? Next question. Is there any more items on this question? Is there an F? No. Okay.
I don't know if it's getting, into the next chapter, but does this accounting equation differ from the owner's equity and the owner's draw in that I thought the owner's draw flipped and then it debited into the credit was decrease.
Okay.
But it looks like it increases.
Stockholders' equity increases on the credit side.
Yeah.
Retained earnings increases on the credit side. So when we do a distribution, it's a subtraction, it's a reduction, so it flips. And you have a debit instead of a credit. With a draw, you only post things on the debit side. With retained earnings, you're going to have things on both sides.
Okay.
Is really the difference that I think might be confusing you. Okay? Cool. Yes, ma'am, you had a question. On which problem? E21. Match each definition with its related term. And which one were you confused about?
P is in Paul.
P is in Paul. Probable debts or obligations to be paid? Or do you have a different version?
I'm in 7.
Okay.
Page 89. Yeah, page 89. Identifying accounts on a classified balance sheet and their normal debit or credit.
I'm in the wrong place. I apologize. Well, let's see here. Let's just do problem 2-1, right? Does anybody have any more M problems that they want to talk about? Because I want to have time to do both of the P problems. Okay. So, P2-1, page 89. ExxonMobil explores, produces, they pull gas out of the ground around the world. The following are accounts from a recent balance sheet. For each account, indicate how it normally should be categorized on a classified balance sheet. Current asset, current liability, non-current assets, non-current liabilities, stockholders' equity. Okay? Also indicate whether the account normally has a debit or credit balance. Cool. Let's just do them, because it sounds like too much fun. 1, notes and loans payable, short term. Short term, is that current or long term? Okay. Is it an asset or liability? Liability. So what would its normal balance be? A debit or credit? Credit. Questions, anybody? Okay. Materials and supplies. Sounds like what kind of an account to you? What? I would think it's an expense, but the book tends to say expense if it is, so it's going to be an asset. There's the little trick, because I'd have gone right down the expense category. So we have materials and supplies. It's an asset. Is it current or long-term? Current or non-current, I guess. It's current because we're probably going to use it up fairly quickly, right? You don't buy materials to leave them sit around for... So I would call it current. And since it's an asset, its normal balance is debit or credit? Debit. Contributed capital. Stockholders' equity. Normal balance? Credit. Everybody follow that? Okay. Yes?
The definition is common stock.
I can't hear you. What?
Number 3 is common stock for the 8th edition.
Oh.
And well, I have a question about that.
It doesn't make a difference. They both belong in the same place. This common stock is stockholders' equity, and it would have a normal credit balance.
But I was just confused about investments, long-term and short-term.
Yeah.
Are assets?
Yes. So if we buy a short-term investment, that means we had some extra cash. So we go out and we buy some shares of IBM. Okay? And hopefully the market value goes up, so we earn a little bit of money while we're investing. But we could sell it at any time we need the cash. So that would be short-term. If, on the other hand, we're Exxon and we go buy some company that just started drilling in North Dakota or something, because we just bought them out, we're going to own this thing forever, that's a long-term investment. So that would go down under long-term investment or long-term asset. Right, we bought another company, so we've made an investment in that.
And then the common stock, that's stockholders' equity versus an asset.
Why is it stockholders' equity instead of an asset? Okay. I need my whiteboard because I can't think without it. So we have stockholders' equity, and there are some subcomponents of this. First is the common stock. This is, people will buy your stock in exchange for cash. So this is going to increase as a credit. Okay, just like owner's equity would. The other thing is, remember we had the issue where we had additional paid-in capital. So they paid $30 for the stock, but it has a par value of 10. I'm sorry, yeah, par value of 10. So $20 would go in additional paid-in capital. That also increases as a credit. Then we have retained earnings. Retained earnings, when you have a profit, it increases as a credit. Okay, so your whole stockholders' equity section, by definition, increases as a credit because it's on the other side of that assets equals liabilities plus stockholders' equity. All of these are debits, and all of these increases credits. So I've gotten away from your question, though. Would you repeat it for me so I do answer it?
No, that makes sense. So common stock is always company stock that's sold to somebody else.
Right. So think about it. We get cash, so our cash increases here, and our stockholders' equity increases here. If assets a debit, this must be a credit.
I was thinking it was stock that they were buying.
See, but that would be an investment. Yeah, I totally see where you're coming from. Absolutely. Okay, are we good? Other questions? How far down were we here? Patents. Anybody is a patent asset, right? Are they long-term, current? They're probably long-term because they're good for 12 or 14 years. I forget right off the top of my head. As an asset, they increase as a debit. Income tax is payable. The key word here is payable. To say this properly, you say, payables are bad. Right? We owe somebody else money. So it's a liability. Liabilities increase as a credit. Exactly. Okay. Long-term debt. Liability, right? We owe someone else money. And it's by definition long-term, so it increases as a credit. Marketable securities, short-term. This is another term that's the same as investment, right? Marketable securities, we bought some IBM stock that we could sell any day when we need the cash. So it's an asset, short-term, increases as a debit.
Wait, so it's just an investment?
Right.
Okay.
Marketable securities, meaning we could sell it at any time and turn it to cash. Property, plant, and equipment. Assets, for sure. So they increase as a debit. Retained earnings. Stockholders' equity, yes? Okay. Increase as a credit. Notes and accounts receivable. Accounts receivable is trade credit, right? I let somebody promise to pay me in 30 days. So by definition, it is an asset that is current because it's short term. Okay. Investments, long term. Asset. Cash and cash equivalents. Cash is king. Very good. Somebody got the right answer. Accounts payable. Right? This is a trade receivable. Somebody told us we could pay them in 30 days. So it's current. We're skipping the last one. Crude oil products and merchandise. Who knows? That's probably an inventory type item. We'll leave that one go.
I looked it up and it was a current asset.
If it's inventory, it would be a current asset, yeah. Oh, you know what I'm forgetting here? The company, the hypothetical company is Exxon, so crude oil to them would be inventory. Yeah. That's why I was confused. Yes?
Tell me what the cash and cash equivalents was again?
Cash is an asset. Cash equivalents are things that you could turn into cash instantly, like stocks. So it's current, yeah. Okay. And then we had problem 2-3. Recording transactions in T accounts. Guess what? We're actually going to do this and I'm going to erase. Who would like to read the first one for me? Don't be shy.
The first account or
The first, does it list a bunch of accounts or does it tell you?
beginning balances?
Oh, okay. Let's do this then. List the accounts for me and then we'll put the beginning balances in.
I have the 8th edition. Should I still do it?
It doesn't matter to me. Everybody's...
Cash,
Okay, so we have cash, right? Okay, I have cash. Balance.
19,000.
Debit or credit?
Debit.
What?
Debit.
Debit. See what I just asked her? I asked her for more information. She said cash has a balance of $19,000. Debit or credit? Do I have cash or have I overdrawn my account? There's a big swing there, right? There's a $36,000 swing, depending on which one it is. So it's important. Cool? Okay, what's next?
Investments short term. 2,000.
Debit or credit? Next.
Debit.
Accounts receivable has a $3,000 debit. Next. Inventory. What's my balance in inventory? Debit or credit? Must be a debit, right? Okay. Next.
Notes receivable long term.
Notes receivable, long term, has a balance of 10? 1,000. Okay, what's next? Equipment. I'm going to abbreviate EQUIP. How much equipment do we have?
48,000.
Next.
Factory building.
Building. Bless you. Balance.
90,000.
$90,000 worth of building? That's what we paid for it, at least. Next.
Intangibles.
Intangibles. How many patents and or other intangibles do we have?
$3,000.
3,000 debit, I presume?
Yes.
Okay, next.
Accounts payable.
Accounts payable. AP. How much money do we owe to others?
15,000. So it's credit.
15,000? Excellent. And it's a credit. Good to note. Okay, next.
Accrued liabilities payable.
Accrued liabilities payable. So we owe, again, we owe money to others. How much do we owe?
2,000.
Okay. Next.
Notes payable short term.
Note payable short term. How much do I owe?
7,000.
$7,000. Okay. Next.
Long-term notes payable.
NP long term. How much more do I owe?
46,000.
$46,000. That's kind of scary. What's next?
Contributed capital.
Contributed. Okay. Contributed capital is what?
90,000.
Debit or credit?
Credit.
Okay.
Retained earnings. 30,000. Credit.
So has the company made money over its life or lost money over its life? Made money, right? Everybody see that? Okay. Yes.
So contributed capital is the same as common stock and additional paid-in capital?
Correct. Correct. Yeah. It's the same as common stock and additional paid-in capital, yes. Okay, next. Tell me I'm done, right? Thank you. All right, so now they're going to give us activities, and they want us to post them. Good. This is good practice for the test. When are we going to have a test? Next week, and it'll be so much fun. Because it'll be a lot like the homework problems, right? So if you haven't done the homework, do the homework. For those of you who've been in my class before, how much like the homework are the exams? How very similar?
Very, very similar.
Very similar. Would you recommend doing the homework?
Yes.
Yes.
I'm not nearly as stressed out as my first test, as I was.
Yes. Okay, questions on when the exam is? Oh, hey, which reminds me, tomorrow morning when I get to work, I'll turn on the online part of the exam. Right? You go on Blackboard, you go to assessments, and there's like a 30 or 35 question multiple choice test. You'll have an hour or so to do it. Has everybody taken a Blackboard exam before? Just so you know, once you start it, you've got to finish. So make sure you have that whole hour or hour and a half to sit there. Because if you turn it off, the clock still runs and you'll run out of time. Okay? I don't want anybody to come back and say, oh, you know, I started and then I went to my friend's house and I couldn't get back into it. That's because you ran out of time. Okay? Good? Good. So I'll turn that on tomorrow. You can take it any time before 6 p.m. next Wednesday night. Anytime. Good? Okay.
And the company analysis is also due next week, right?
The company analysis is also due next week. There's great directions on what I'm looking for in the, or great description in the instructions. which is also on Blackboard. If you have questions about that, we'll tackle that after the break, okay? I'll let you guys ask questions about it. Cool? Okay. As far as the exam goes, I will hand out everything you need except for a writing implement and a calculator. Okay?
Use your phone.
You may not use your phone. You may use a calculator, but not your phone. Okay? Good. All right. What's our first transaction that we need to post?
Purchase short-term investment for $9,000 cash.
So we're going to buy a short-term investment. Here's short-term investments. We're buying more, so it's an asset, right? It increases as, on which side? Debit. So we've got $9,000. Let's call that A. And what did we give up in exchange for this?
Cash.
So we've got $9,000 decrease in cash, because cash decreases on the credit side. Everybody with me? Okay. I like this problem. It's a lot like a test question I've seen somewhere. Okay. Anything else with A? Moving on to B.
Lend $7,000 to a supplier who signed a 2-year note.
A 2-year note is a note receivable, and it's 2 years. So is it long-term or short-term? Okay. So a note receivable long-term, this would be the account. It increases on which side, debit or credit? Debit. How much money do we lend him? $7,000. So I'm going to debit it for $7,000. This will be transaction B. And what did I give him? Cash, right? B. My debits equal my credits? Everybody happy? I even see smiles. All right, C. What is C? Anybody?
Purchased equipment for, I mean, I have a different amount, but 18,000 in the edition.
Okay, so
5,000 cash.
we bought some equipment.
Yeah. It's for 18,000.
Okay, hang on. $18,000 worth of equipment. Okay, equipment increases on which side? Debit. So I'm going to record 18,000. And I paid how much cash? 6,000 credit to cash. I'm not in balance though. I have 12,000 left. 1-year note payable. So I have a note payable. Let's go over to our, it's a 1-year note payable. Is it long-term or short-term? If it was longer than a year, it would be long-term. But it's 1 year exactly, so we'll call it short-term. And it's 12,000, right? 18 minus 6. And liabilities always increase on the credit side. Questions on that? Anybody? This is our first 3-legged entry, right? 1 leg, 2 legs, 3. I have a 3-legged entry here. I want to make sure everybody's comfortable with it. Good? Yes, no, maybe. Somebody in the back row, nod your head yes. Or no. Or no. No would be fine too. Okay. D.
Hired a new president at the end of the year. The contract was for $85,000 a year plus the option to purchase company stock at a set price based on company performance.
Okay. So we hired a new president of the company today. And we're going to pay him $85,000 a year. What am I getting? I'm getting an employee. Have I gotten anything from the employee yet? No. Has he started yet? No. Has he done any work yet? No. How much money do I owe him? Nothing. Do I have to record this anywhere? Nope. This might go in the notes to the financial statements, or, if it indeed happened the last day of the year, but there's nothing we need to record up here in our general ledger. Everybody good with that? Okay. What's next?
Issued an additional 2,000 shares of capital stock for $12,000 cash.
Okay. We issued 2,000 shares of stock for $12,000 cash. Does it tell us what the par value of the stock is?
They do in the 8th edition.
Okay. So in the real world, you would have, this would be stock, and you'd have additional paid-in capital here. So how much is our par value? It's 50 cents. And how much money did we, or how many shares did we? I'm sorry, 2,000 shares. 2,000 shares at 50 cents a piece is how much? $1,000 in capital or stock. We'll just call it stock here. So our additional paid-in capital is the difference between 12,000 and the 1,000. So we'd have 11,000 go here. And I think I'm on E, right? E. So what's my other entry? Cash, right? I got cash in exchange for this. So I've got my 2 credits over there. Cash would increase by how much? The whole $12,000 as a debit. So there's the more detailed way to look at it, or the way the 8th edition does. I actually like this better. Sir?
I don't understand what you just said.
Okay. We sold some stock. I need space to write. We sold some stock. Remember we had that conversation about par value earlier? This is 50 cents par value. And we sold it for, we sold number of shares, 2,000 shares for $12,000. With me so far?
Yeah.
Okay. So we record the par value in the stock account, the capital stock account. 50 cents times 2,000 is $1,000. It goes to the stock, a common stock account. Good? So the rest of it, by definition, goes in the additional paid-in capital account, which is the 11,000. Because they paid us 12. The people who bought the stock. The market value was $12,000 for the stock. It's selling for $6 a share. You see that? So they paid us 12. By definition, the common stock account only reflects par of those shares, which is $1,000. Good with that concept? Okay. So the rest of it, by definition, has to go in the additional paid-in capital account. So that's why we put the 11,000 there.
And they're paying more for one share because our company's doing one.
Theoretically, that's a very simplified answer. Yes. I'll say yes. But the reality is, par value is a stated value. Basically, the company management got together and said, hear ye, we shall make the par value $7.23. It's a number they picked out of the air. Okay? Typically they pick $1, 50 cents, 10 cents, something like that. But it's just we're stating that the value is this. It's just printed on there, right? Like if you ever get a coupon, it says at the bottom, this is redeemable for a ticket to the movie or 9 cents. The 9 cents is a stated value. It has nothing to do with market value, which is what the $12,000 represents, or $6 a share. So they're not connected in any way. So the way to make up for it is you use this additional paid-in capital account. Good? Cool. Yes?
Are we going to do par value things on the exam?
Oh, you betcha. Yeah. You just need to know, you take par value, and that's what goes in the common stock account. The rest goes in additional paid-in capital. You will be fine. Okay? Yes, ma'am.
If you were given like par value like we were in the 7th edition, how would you calculate that?
Okay. In the 7th edition, they only gave us contributed capital. Contributed capital, by definition, is this one plus this one. So we would have just lumped the two amounts together. Here is $12,000 and shown cash and been done. Okay? Because I think the 7th edition doesn't cover additional paid-in capital till a later chapter. But we're covering it now because you guys are smart and you can deal with it. Fair enough? Okay. So that was E. And if there are no further questions, let's go to F.
Borrowed 12,000 cash from a local bank payable in 3 months.
Okay, we borrowed some money. What did we get? Cash. So cash goes up, which is a debit or credit? Debit. F, it was 12,000?
Yes.
12,000 cash increases, debit. And we borrowed it from a local bank, so it's a note payable. And it's payable when? 3 months. So is it long-term or short-term? Short-term. So I have a note payable short-term. Liabilities increase on the credit side. Everybody say credit side. Okay. When you guys take this exam next week, you're going to want to know debits and credits. So work with me here. Think through it, okay? This is a good review for that. Questions on F? Is there a G? How many more are there, by the way? I? No problem. What's G?
Purchased a patent for $3,000 in cash.
We're going to buy a patent. A patent is what type of, is it an asset or a liability? It's an asset. So we're going to buy a patent for $3,000? Okay, so G, patents are an asset, therefore they increase on the debit side. So that's what we get. What did we give up? Cash. Cash decreases on the credit side. G. Good? Okay, questions? H.
Built an addition to the factory for $25,000. Paid $9,000 in cash and signed a 3-year note for the balance.
So we built an addition to the factory, so that's a building for 25 grand. Buildings is an asset, it increases on which side? H, $25,000. Okay, and we paid for it how?
9 in cash.
Okay, so cash is going to go down, which is a credit. And the rest was a note payable that is long or short term? Long term. Liabilities increase on which side? Credit. So 25 minus 9 leaves me. And that's still H. Questions on that? Yes, no, maybe. Not, yes, sir. You, yes. That was a...
I don't believe I put my hand in.
Oh. False start. 10-yard penalty. Okay. I.
Return defective equipment to the manufacturer, saving cash refund $1,000.
Okay. So remember we bought this equipment for 18 grand? Some of it's no good, so we're returning it. So how much are we returning? 1,000. So this equipment's an asset. It increases on which side? And it decreases on credit side. So I need a $1,000 credit here, and I got what in exchange? A refund, which would be cash. Good? Fun? Okay. Is there a J?
Nope.
Okay. So we're all done with them, yes? Is that all the problem asks you to do?
No.
What is it? What else does it want us to do?
Balances,
I'm sorry, what?
enter balances.
Calculate the balances. Okay. How do we calculate the balance in an account? Add up all the debits, subtract all the credits, right? So, for example, inventory only has one entry. I can just tell the world, I did the math and that's the balance, and double underline it. I'm good, right? If I get over to inventory, I draw a line, I do the math, it's 11,000, and I'm good. Okay? Cash, someone's going to have to do the math. 44. What? 44,000? Thank you. Okay. Notes receivable long term is 8,000. Debit. Accounts receivable, double underline it, there's only one. What?
Should be 10.
What?
One debit side was 44, and the credit side was 34.
Hold it, you're telling me what?
She was just giving you the $10.
She's just giving you the,
Okay, hang on, that's great, because people will do this on the test, is they'll total this up, and they'll total this up, and they'll write them both in, and then they'll do more math. Don't do that, because it confuses people. All you're supposed to do is write the balance in. Okay, it's 10 even? Okay, 10, don't show me the other stuff. That's the appropriate way to do it. Good? I'm glad you brought that up, because someone always does it the other way. And I'd hate to see you do that. Okay, so equipment. 48 plus 18 is 66 minus 1 is 65. Good? My math is okay here? Building is 115,000 debit. Accounts payable didn't change. Intangibles is 6,000 debit. Liabilities payable stays the same. Note payable short term 2431. Note payables long term 62. Retained earnings stays at 30. Contributed capital is 91. Sorry. Stock is 91. Additional paid in capital is 11. And we're golden. Yes?
Well, in the, when it has the two different accounts, it had common stock starting at 10 and additional paid in capital starting at 80.
I think we mixed both the books together.
We did. We're just going to go with this for now. All right? I don't want to confuse it by trying to go back and correct something right now. Okay? Okay. So, what else does the book ask us to do?
Prepare a classified balance sheet at December 31st, 2012, and also compute the current ratio for 2012.
And a trial balance.
Okay. The next step in my world, I'm going to leave the book behind for a moment. That's your general ledger. Those are the balances in your accounts. There's numbers all over the place. We need a way to bring that all together to make it easy for us to prepare the financial statements. Good? So we're going to use a little tool that's called a trial balance. Trial balance would have the company name, the who, the what is trial balance, and it needs a when, which I don't know what that is out of the problem. So a trial balance is simply a listing of your chart of accounts in assets, liabilities, owner's equity, or stockholders' equity, revenue, and expenses order. So I'm going to list cash, investments, short-term, accounts receivable, inventory, notes receivable, long-term, equipment, building, intangible assets. Then we have AP, right? Note payable, short term. Liabilities payable. Note payable, long term. Stock. Not an H, it's a K. Additional paid in capital and retained earnings. Good? Okay, so then we have a debit and a credit column. So we start with cash. My balance is $10,000 debit. My investment short term is, if I write it down correctly, it's 11,000. Debit. Accounts receivable is 3,000. Debit. Inventory is 24,000. Debit. Note receivable long term is $8,000 debit. Equipment is $6,500 debit. Building is $65,000. I'm only off by a factor of 10. Come on. Building is $115,000. Intangibles is $6,000. Accounts payable is $15,000 credit. So I move to the other column. Note payable short term is $31,000. Liabilities payable is $2,000 credit. Note payable long term is $62,000. Capital stock is, or common stock is $91,000 credit. Additional paid in capital is $11,000. And retained earnings is $30,000. We now total those. And somebody needs to help me with the math. Everybody agree? Okay, so my debits equal my credits. I am in balance. Life is good. Everybody with me? Questions on how I put this together? If anybody wants to run up here with their cell phone and take a picture, feel free. Okay. So with that said, I'm going to erase all these. Is everybody okay with that? Right? Because we have all the data over there now. And I need the board space. So the book now wants us to create financial statements. Is that correct? Okay. Can we do an income statement? No, we have no income statement accounts, do we? Correct? Okay. So we're going to do a balance sheet for... Remember that every income statement or every financial statement has a header, who, what, and when. Who, I don't know the name of the company right now, but it's balance sheet for the what?
Cougar Plastics Company.
I appreciate that, but who is much easier to write. What is the when? You can tell me that. December 31, what year? 2011. Cool.
2012.
Are we doing 12?
Because they gave us the starting of the...
Okay, so this would be 2012. Okay?
It says during the year 2012, and then we just...
Here's what happened. So this would be a 2012. Good. Okay. What's the first part of the balance sheet? Assets. You need that header. Under that, we're doing a classified balance sheet, so we would go current assets. Let's come over here and talk about this. What are our assets? Cash all the way through intangibles. There's your assets. Our liabilities are here. And there's our stockholders' equity. Good? Okay. So which ones are our current assets? Cash is current. Short-term investment is current. Accounts receivable is current because it's 30 days. Inventory is current. Note receivable long-term, not current. Equipment, building, and intangibles. Those are property, plant, and equipment, so they get their own category. Good? Okay. So our current assets are cash, of which we have 10,000. Investment, short term, of 11,000. Accounts receivable of 3,000. Inventory of 24,000. $1,000. And then we're going to get total current assets. Underline this, 24, 34, 45, 48, right? So notice what I'm doing. I'm setting up some columns here. I like to total down one column, and then I'm going to line things up out here to total down this column as well. So total this, kick it out. Now I'm going to do what's second after current assets? Let's go property, plant, and equipment. Okay? Property, plant, and equipment. I'm abbreviating. I have equipment. I have building and intangible.
Why doesn't intangibles go in property plant?
What?
Take over the counts as property?
Yeah.
Or should it, I mean, can it go with the notes?
We can put it down in what we'll call other assets, okay? Because, yeah, we can argue that. But an intangible is something typically like a patent, so it's really a tool that you're using in the company. So we could argue it either way. Let's put it in the other account. Okay, how much equipment do we have? 65,000. Building, we have 115. Total property, plant, and equipment of 180, right? Everybody good with that? My math's okay? Okay, so now we're going to go other assets. And we'll put intangibles down here, okay? And note receivable long term. 6,000 and how much is my note receivable? 8. Total other 14,000. What's left? Total assets. 48 plus 180 plus 14 is how much? Double underline it. There's my total assets. Questions on any of that? Admittedly, going a little faster than I should probably, right? Property, plant, and equipment. Other questions? Okay, what's next? Liabilities. And our first liabilities are current liabilities. What are our current liabilities? Let's come over and look. Accounts payable, yes. Short-term note payable, yes. Liabilities payable, yes. Note payable long-term, no. So we'll draw the line there. So I have accounts payable. And how much is that? 15,000. Note payable, short term of 31,000. Liabilities payable of 2,000. That's all of them. So now I have total current liability of 15, 46, 48. So I'm doing a total, so I kick it out into the next column. Good? Yes, no, maybe? Yeah. Okay. Do I have more liabilities? I have note payable long term all by itself. There's only one of 62,000, so I'm going to kick that straight out into the other column.
There's only one, you don't need to make one.
Don't need to do a subtotal. Okay? And no other liabilities, so I then have total liabilities of 110. Good? Questions? Okay, next section is equity. Okay. Anybody have their book out? How does it start?
Common stock.
Common stock is first, right? It develops into a more detailed element later on. I just want to make sure the book doesn't do it to you like version 8 doesn't do it to you now, so I don't teach you different. So we'll go with common stock. And how much common stock do we have? 91,000. What's next? Additional paid-in capital of 11. And what's last? Retained earnings of 30,000. Total stockholders' equity. What? 132. What's left? All I have to do is add together my total liabilities and stockholders' equity to give me total liabilities and stockholders' equity of 242. Double underline, show the world I'm done. Am I in balance?
Yes.
Right on. Good? Does the book ask us to do anything else with this?
Use the current ratio.
Okay. What are the components of current ratio?
Current ratio equals current assets divided by current liabilities.
Over current liabilities. Where do I find current assets from? Right there. Where do I find current liabilities from? Right there. Huh. Equals 48 over 48 equals 1.0. Do we have enough cash and current assets to cover our current liabilities? Yes. So we're okay. Just barely. But we're okay, right? Questions on that? Any of this? Yes, no, maybe?
No. Makes more sense now than when I was doing it yesterday.
It's always easier when somebody else does it, right? It's good when we all do it together. Sir?
So when you're looking for the ratio, you're only dividing the current assets?
Current ratio is current assets divided by current liabilities. So yes.
Not the total, right?
Not the total assets and total liabilities, no.
Okay.
Why is that?
Because you're looking, it's a liquidity ratio. I want to know if I can pay these debts. Do I have enough? Do I have the ability to pay this? So if I had $10,000 in current assets and $48,000 in current liabilities, what am I? In deep trouble, right? I don't have enough cash or cash equivalents to pay this. So that's why we're testing it. There's another hand up.
The book was just talking about the ratio that it says a ratio above 1 normally suggests good liquidity, but many use sophisticated management techniques to minimize funds invested in current assets and have current ratios below 1, and then
Yes.
too high suggests inefficient use of resources. So I was wondering what exactly, if you could explain that more.
Okay, so let's talk about inefficient first. If my liabilities are $48,000, current liabilities are $48,000, but my current assets are $3 million, do I have money sitting around that could be working and doing something to earn me money? Yes. So that's inefficient. Management techniques would be something like I have a line of credit that when I write checks, the checks clear against the line of credit, so I could have no cash, no current assets on hand, but the money will come out of a line of credit and cover this. So you could have a ratio much less than 1 and you'd still be okay. But you've got all your assets tied up and they're all working. But you're paying the interest rate, the fee for borrowing the money. So, that's just an example though. Okay? Other questions? Yes?
What's the unit of that? It's percentage, dollar?
Yeah, it's 1.0. It's 48,000 divided by 48,000 gives you 1.0, okay? Or 100%. You could call it 100%, but it's always referred to as 1.0, 1.2, 0.8, okay? 0.7, point.
Dollars,
No.
there's next up.
It is literally a ratio,
Okay.
okay? Other questions? All right, you can stop that. Here's what we're